the screens. This is obviously just for the NASDAQ. And you can see that from 12 o'clock through to 1500 hours, you can see that it's dominated by red, 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 and a little bit more red, just to add to the red that we had before. And, you know, when you start to recognize all that red, of course, generally as a rule, what you should be normally thinking about doing is, guess what? Selling it. So the idea is why it's painted red is because you should now try and work short sell trades against that storyline, because you're getting that price. Now, when you get that supply, you should be marking it on the screens. So let's take an example of what that kind of looks like. So we'll find where that knowledge comes in, that supply line comes in. Okay, so let's just see what happens here. So the first thing we're looking at is 1239, supply. So we're finding 1239 in our charts, right? Supply line, 1239. And all you do is you mark it. Supply, what did they do with that supply, guys, at 1239? Sorry, 1239 is the 1238 candle. What did they do with that supply? They never bought it, did they? So we start recognizing that that is now a sell press. 1240, 1242. I'm not going to mark them all, guys. Okay, so 1240, the 1239 candle, supply. They sold it again. 1242, supply. They sold it again. 1243, 1245, supply. 1243, 1245, supply. 1244. Now we're starting to see something. What did they do with that aggregate supply at 1245? What did they do with that aggregate supply at 1245? They started to buy it. So we're getting the first piece of information from the aggregate supply on its own that there's probably a little pause coming. In other words, when we see that supply being purchased, we can now look at that as a possible, at least a short-term bottom edge for a possible buy reversal. Possible, I'm saying possible because we don't know anything else about it except what's happened to the supply. Does that start to make sense now? So as I said, I don't intend to mark off all of these supply candles, but you can see that we then started to get into heavy supply again at 1310, and the whole thing starts over again. There's 1310 right there. And obviously you can see again, they supplied it. So you're generally, as a rule, staying short through that phase. 1317, the next supply comes in. There's 1316. So there's the supply coming in again. So when you get a sell and it drops, your job is to be a short seller. Supply and it drops. There's a beautiful short sell spring opportunity there. Supply and it rallied. There was a possible fade. Supply and it dropped. Top edge short, supply and it's selling. Keep pressing it, keep pressing it, keep pressing it. 1318s, 1317s, 1318s, 1317, 1318. There's 17s and 18s. You can see that 17s and 18s, they kept selling it, still selling. So you should be still working that sell. 1335, new supply comes in. 30, 31, 32, 33, 34. There's 1335. New supply comes in. Now, they started to buy it, but obviously they didn't take out the candle, so that's obviously still a sell. And unless it takes out the candle, you can't tell because you don't know where the volume came in. It could have been at the beginning of the candle or the end of the candle, so we just make the assumption that it's going to always at the high of the candle. So that's still a sell. So you can keep going after these supply lines. So you could have sold here, sold here, sold here, sold here, sold here, sold here. Sold here, sold here, sold here, sold here, etc., etc. Went after these trade areas. And you can see that it keeps going. 1400, 1401, 1402, cash open, into the cash open, right? And then all the way through to 1500 hours. All the way through to 1500 hours, it was still sell side. You see that? So in other words, those sell orders started over here. Those sell orders started way, way, way back over here. And unless you have a very strong commercial story to buy against those sell orders, you should be doing nothing of the sort. Nothing of the sort. So when we start to move into the bottom line prices, and we start seeing that there was a short sale coming in at 17s against a volume, which is interesting. So you can see that there's a bit of volume coming in on the buy side. And what do the futures traders do? We're expecting fund hedgers to sell to that buy volume. And that's between 1518 and 1519, right? Because we'd get that information between 1518 and 1519. So there's 1518 there. And there's obviously now we're getting that information there. So obviously we're now looking at 1519 and we're starting to say to ourselves, okay, it's a sell trade, right? Would you agree with us? Would you agree that that's what the phone call is telling you to do? Is start working into that as a process. Yeah? So how did that sell come out? How did that sell come out? Futures offers expected from fund hedgers. How did that futures offer from fund hedgers play out? Pretty good, right? We've just went from 312s, and we've just traded a low price there at 250s for 60 points. That's a $1,200 short sell into that absorption there. You know, because we can start recognizing these things. We don't get a Heisman there, but guess where we got the Heisman? So at the moment, this is a very, very dangerous fade, agreed? If you are pricing this market at this stage, where was your actual offer? Well, if we go from that candle to that candle high to that candle low there, and we say, well, my original offer is now going to be at this price here. Everybody happy with that? Using the classroom we did on pricing the market. So when the second candle comes in and we go from that candle low to that candle high there, we say, okay, well, where is your new price? Is the new price higher or lower than the old price? Well, the new price is still higher, isn't it? So it's still very dangerous to sell it, correct? It's still a very dangerous sell. And when this new price comes in, is the new price higher or lower than the old price? Higher or lower, Simon? Higher or lower? Higher or lower? What's that trade game? That game, higher or lower? It's lower. So on the basis that it's lower, is that starting to give you informed information now? Are you starting to get information that tells you, wait a second, if the offer is starting to press down, you see what happens? I mean, you've just been given an ace at the end of the table, haven't you? You've just been given a king at the end of the table and you still get that idiot. You know the idiot I'm talking about, right? As they get a king at the end of the table and they say, higher, higher. And you go, sorry, what? It's a 2. Why would you want to go lower? So we start seeing the offer coming in a little bit. And when this little fella trades here, what happens to the offer? It comes in even more, doesn't it? See it? You see what I mean? It comes in even more. And all of a sudden, you're coming to meet the sell price. And obviously, when this little fella prints, you're actually right on the actual price itself. Do you see how easy that process was to get the perfect sell price by pricing your market properly inside of that sell signal coming in from the fund hedgers? In other words, you got the phone call at 1519 and you executed at 1526. You see it? You executed at 15:26, 7 minutes later, because you started to use this concept of pricing the market properly to make sure you weren't jumping into a market that simply had no value for you to do so. So we started to watch the story, watch the story, watch the story. And then what happened? We got the supply coming in at 39. There's the 38 candle. There's the 39 candle there. We got supply. Is that still selling? Sure. We then got supply at 40. Is that still selling? Sure. And then we got supply at 41. What did they do with the supply at 41? What did they do with the supply at 41? They took it bid, didn't they? They took the supply bid at that stage. And if they take the supply bid at that stage, and we don't know where it came in, it's probable that it came in, maybe in the middle of the candle, you would imagine. But obviously, if we take out the top, there's no demand, there's no debating what happened. This has now changed the story, hasn't it? This entire story has now changed. So what are we going to do? We're going to exit our position, aren't we? If we're an intern, we're going to now exit our positions and say thank you for that phone call. Thank you for the phone call. And yes, if you were pricing the bottom edge, we never got a phone call, remember, Miguel, but yes, if you were pricing the bottom edge, you would absolutely have started to find the bid was starting to press up towards the price itself, weren't you? Starting to see that storyline coming to your attention. And as that storyline comes to your attention, you go, there's the bad boy right there. That's the one I want to take advantage of. So there it is. There's your NASDAQ short. You seeing it? You seeing it? No, yes. Is that making a lot of sense? Now, obviously, when you understand that, this isn't the intern sell. That's not the intern sell. Because the intern sell is now getting this fund hedger on the phone saying, sell me. So the intern worst case scenario has to sell if the market breaks off of that price, right? So as soon as you get that candle forming there, the intern is now looking at that and saying, well, it's a sell trade, it's an offer, it's going to be at higher prices. If the price starts moving down, I've got to be selling it. And obviously that means that the interns may have started to sell into this candle here just because the price started to break down through that candle area. So it wouldn't be unusual for the interns to maybe have got a little bit of short business there. It wouldn't have been unusual. Now, it doesn't take out the candle low, so you might argue that it needs to take out the candle low to get that interns trade. Remember, they're not allowed to sell on the uptick, so they've got to sell on the downtick. So at that stage there, you might have been able to sell it there. It never sold here. So obviously the interns trade would have been to sell in there, wouldn't it? Well, you can see that you managed to beat the interns substantially into that top edge at that stage. You see it? Make sense? Bits and pieces. So the idea of starting to price up the market accurately starts to allow you to make these decisions. It allows you to start taking these ideas and start evolving with them. Because when we saw that, as Miguel rightly mentioned, if I was originally pricing a bid into this market, can we all agree that the bid would have been at this price, yes or no? Is that where everybody's bid was here? Would everybody agree that that's where the bid is? Yeah. So if that's the original bid, and then we move into the next candle, can we all agree that the bid's just managed to rise ever so slightly now? What do you think? And as we move into the last candle, can we start pricing up the bid at that stage? is obviously significantly higher. You see how you're starting to get closer to the price based on volatility? So as soon as that starts moving up, you can start getting ready for a transition, can't you? Agreed? As soon as that starts moving up, you could get ready for the transition trade. So when you start seeing it starting to come into play here, you can start saying to yourself, well, if I could get a transition trade, if I could understand that there was maybe say you'd got a phone call a few minutes earlier from one of the commercials, you've started to see a Charlie D transition coming into your screens, an order flow transition. You'd have been able to start working with that seller in that area. You could have started to use that seller. Somebody used the seller. Look at the size of the candlestick. Somebody was reading that as a trade, weren't they? Somebody was taking advantage of that price to get, and it might just be the sellers booking their profits. That wouldn't be unusual, because if we look in the background, if we do that as a measured move and we take off the pins, we can agree that that was pretty much the measured move, right? And as you know, I like to take off the pins. I always like to get a conservative measured move on these trades. So if we can all agree that that was your measured move price, yeah? So all of a sudden, the measured move, the bids, the tie-in, the processing of this as an idea, the concept, the idea how it's evolved, it's not really a surprise that you made $1,000 on that deal, is it? It's not a surprise. It was where you would have expected it, in fact. It's exactly what you would have expected from that bit of business, isn't it? So we can see how this story evolves into this point, can't we? And we're waiting on some more phone calls, and you can see the phone's quite quiet so far at the moment. Phone's quiet. There's not a lot of people on the call here, right? So you've just made $1,000. Do you care as an intern? You can stand there with your arms folded and wait for something a little bit better to show up, right? There's no value lines in this chart. There's not a single value line in this chart. You're waiting for a phone call. You're on the floor of the exchange. There isn't even a big board. Oh no, there's not even a big board. All you're doing is waiting for the next phone call. Yeah? You see how it can work, guys? Do you see how the process can work? And obviously, as we go through the interns exercises, you start recognizing how to deal with the phone calls, how to deal with this idea, how to deal with this information. That's where we start getting those edges, so that when we take the trade, we're getting this price instead of this price. And now it starts to make a lot more money. When you get that price, you're always facing this type of thing that happens here. It breaks, you're starting to make some money, and then it stops you out at break even, and all of a sudden you say, damn it, scratched. And then because you're thinking that it's going to go back up to the top edge, then don't take advantage of what ultimately happens as that sweep takes place. How many people get taken out at break even only to see the market ripping in their favor? Hundreds of thousands of retail traders every single day see that situation. They get the right deal, they get scratched at break even, and then it rips. Every time. Every time. Crazy, isn't it?